Hey, how's it going, everybody? Welcome back to mentfx, and in this episode, we are going to take a look at Wyckoff. So, as a lot of you probably noticed, I have removed the previous. Well, I've unlisted and made it private for my mentorship that we went over in the last video. But as you all have noticed, that video went down, and this video is the one that's going to be coming up. So, what I realized about that video is I went very quick. I looked over a few things way too quickly, and for a trained eye, it might have been enough to completely change their entire trading perspective. But to most people in an untrained smart money eye, or even an intermediate Wyckoff student, it could have been very confusing and just seemed like a bunch of mumble. So we are going to start in a place that will make sense to everyone from somewhat of a beginner perspective, and we're going to very quickly move that up into the advanced perspective, right? And I hope that a lot of you have seen or have studied the previous videos we've had out so far. Again, those are going to remain free. I have no problem with that. Again, the concepts are not my own. I just have a way of explaining them that I believe is understandable to a lot of people, different to others, okay? So just from a perspective, so I actually had this with a student a few days ago, but now let's take a look at this. Okay, so very quickly, we're going to start at beginner level and just work ourselves up very quickly. But I hope that a lot of you have seen the other ones concerning institutional order flow in the form of inefficiencies, order blocks, imbalances, how price moves, retail versus liquidity. All those videos are going to kind of play a part in this, and some of the terminology may not make sense to you in this video if you have not seen that. So let's get into it. Right, very simply, there was this guy named Wyckoff. There he is, this cool little guy. And what he did, that kind of looks like a dog, but we'll get rid of that. So what Wyckoff right here, right, his name was Richard Wyckoff or something like that. What he did is he was trading stocks. And what he noticed about stocks is they undergo phases of accumulation and distribution, which is nothing more than price moving lower, right? Then all the supply in that stock being taken over by the bank. So as people start selling, right? So again, very simply from a retail perspective, right? Retail or emotional people, right? Not all retail traders are trading this. It could be also just emotional people or emotional companies. So retail traders sell, right? More retail traders selling in here because they're expecting those lower prices. And at a point where a lot of people believe something's going to happen, right? Which is the basis of smart money, where, you know, if the masses are doing one thing, the composite man will do the other. The composite man will begin buying, right? So composite buys, right? And the point of this is then when he begins buying in this area, we have some kind of consolidation, and this consolidation is known as that area of accumulation, okay? And there are two main schematics that Wyckoff teaches, right? And generally they look like this, right? So you have your move up, the PSY, buying climax, automatic rally, an ST, maybe a sign of weakness, an upthrust distribution, a test, an LPS, and this continuation down that starts that mark down, which eventually will come to, so let's just imagine this is the low, right? Let's just boom, just like that. So this is coming down, and eventually it'll come down to start distributing, right? As everybody starts to sell the market, we have a preliminary support, a selling climax, an automatic rally, an ST, maybe a little upthrust that takes out that automatic rally. This ST and B, right? That spring, that test of the spring, that LPSY, and then that continuation much higher. Right, so again, we can label these, but don't get too confused by the labels because they're not what's important. What's important is what's going on here, right? And what's going on here is a transformation of all the people that are selling into this market into the composite man's buys, which then takes it higher. Or in this case, where all retail or emotional people are selling, or there's a lot of buying, and there's a lot of buying going on. This is where the composite man begins to sell, right? So that's why we consolidate. If a lot of you don't understand why the point of consolidations and trends are, right, you already probably do from my other videos, but the idea is when we consolidate, we create one on both sides, liquidity. So when we grab that liquidity, we use that liquidity to do one of two things, right? We grab stops, or we take stop losses for the purpose of profits, and we move in a given direction because we take it, or we create that order block, right? Move into that order block to mitigate some of the blocks that we had, some of the positions we had to use to create this block, and then move significantly higher, which is all part, this itself is all part of these two schematics, right? The idea is that Wyckoff just took it and created a rule-based system for the type of swings you can expect in the schematics, which is why a lot of you have probably noticed the schematics can change or look differently depending on where they happen, when they happen, and how they end up happening, right? So here you go. Here's your spring, right? Here's your test. Here's your LPS, last point of support, and here's your test up here. Here's your last point of supply, and here's your last point of supply. Now, not every single schematic or consolidation or area of distribution or accumulation that you're expecting to see prices go higher or lower in will look like this. Why? Because prices move in different ways and create liquidity in different ways. But the reason it's important for you to understand why we took so long to explain Wyckoff is because Wyckoff should not be used to quote unquote predict direction, but it should be used to understand where you can get a refined entry or even how price normally moves, right? So everything we've learned so far concerning price moving and inefficiencies and to liquidity and all this other stuff is seen in this, right? So you have buying clients, maybe an ST, making those equal highs, right? You have that liquidation of it, that move away, a liquidation of it, right? What does people start seeing? That trend line form. People want to start buying this trend line. And at that point, as they're starting to buy this trend line the most, we break through it, right? We start testing areas in here, making lower prices, and then we start taking off as we've grabbed all the liquidity that rests below these areas, right? As we go much lower, right? People still think there's an uptrend until we get all the way down here, at which point they start seeing the downtrend, right? And they get very confused, and all of a sudden, price starts to accumulate and go higher. But the reason price doesn't always the reason that consolidations don't always have to look like this, right, is because one, the market's fractal, so it could look like this on one time frame, but not on another. But secondly, it's the point of what is happening in terms of the composite man or the banks versus retail or versus emotional traders instead of the actual schematic. So it's actually happening just from a standpoint of what we've learned, right? If you want to look at it this way, we come up, we create, like, let's say a little order block here, right? That order block forms. We come up here, we come down, trade off that order block, come higher, creating liquidity. Now, as we come lower, we take out the sell side liquidity, right? Filling in potentially an imbalance here, right? This is how we can use this to understand what's actually happening in price. This move higher is to grab that liquidity, right? So we have that move lower into an order block, then another move higher to grab that liquidity there, a move lower that might trade off the block or might come even lower to take out a trend line of liquidity, right? So this is how trend lines can actually now be used if you are a retail trader, instead of having them as a sunk cost where well, that's what I call it, a sunk cost, because you learn all this retail stuff and then you notice that some of it's like you just don't want to trade it because it's kind of useless. But what you'll start to realize is you can start to actually trade trend lines because you understand where price is going to be taken out. So instead of looking to, buy from them, you can be looking at them as huge areas of liquidity, right? So as we start moving down, the test is usually at an order block, right? That move lower, maybe you come up to the ICT breaker or the structure block, right? Maybe a mitigation, and we mitigate down until we take off. This is the idea of Wyckoff. You have distribution and you have accumulation, and you have a few different schematics for them. Now, if you want to study the schematics and understand them deeply, then you should just use one of the online resources that are available to you. Just use Google or something, or look it up on the Stock Charts website. It's all there, right? But all you have to understand is that these are normal moves of liquidity and normal moves of price in terms of inefficiency. However, you can now apply a schematic to them. So now, understanding this, based on all the other videos you now have an extra tool in your arsenal. And that is huge, in the form that you already understand how to look at structure on higher time frames. You already know how to look for certain things or order blocks or fills of imbalance, right? Maybe fills of half of the imbalance. You already know how to look for all this stuff. And you already know what to expect at areas like that, right? For instance, price moves to inefficiency to grab liquidity. Maybe there was liquidity in here, right? It comes to grab it, then it moves higher to an area of order block and then moves lower, right? Something like that. You already know how to anticipate, in some cases, what price may do at certain areas in price. Now, sometimes you're going to get that order block or that imbalance area wrong, right? And oftentimes you're not. But what you can start to do is you can start to zoom in on areas like these and look for those things to play out, right? And then maybe as price approaches that, so here you go, here's your imbalance, right? Here's half of that imbalance, and you're expecting price to do something here, like a move away from it. As price approaches that, right, you might have that preliminary support, maybe that selling climax, automatic rally, maybe an ST, here's your ST and B, here's your spring, and now, right, your whole, you understand that you can get in here, and when you get in on this test, right, you can expect those prices to take off above this, right, and then you can imagine this is that reaccumulation of a bigger time frame and look to target these highs in the form of what? Liquidity. right? So now we're starting to put all these things together. So those top-down analyses you've seen me do, the reason I started doing them without any Wyckoff in them at all is because I wanted you guys to understand that you can predict directional bias and understand what the market is most likely to do based on nothing more than price movement and inefficiency movement and areas in price where you can expect that movement, right? And using like order blocks and liquidity grabs and all that other fun stuff. But now I'm showing you that you can now refine areas, or in some cases, wait to get in somewhere by waiting for a certain schematic to unfold. So that's the type of thing you see here, right? So I was just doing a little bit of backtesting on GU, and I was just looking at a few things, right? Using those ideas of trend lines, using those breaks, using those liquidations as ideas of where springs happen, right? New springs happen, moves up, we get tested them. Here's your continuous moves up, right? We get the spring that happens that gets tested, but doesn't come all the way down here, which I was expecting. Unfortunate, it happens, right? You have a new area of accumulation where you have, right? If we just want to zoom in on this, you'll notice that this is nothing more than an order block, right? As you can see right here, an order block that forms after taking out the lows, right? Moves higher, here's your move back to the order block, move higher. Here's your move back to that same order block to get a little bit lower, to take out these lows, here's your move higher, right? And again, it just happens over and over. Here's your trend line, here's your order block through, that manipulates it, here's your move higher, here's your trade right to that order block, here's your move higher, right? I was looking at the sell here because I was just backtesting to test a few counter trend trades, and this one just did not work out. So, you know, you're going to have some of those happen too. But the idea is in all these areas, you can have Wyckoff unfold. And the Wyckoff, as you can see from this, will look different sometimes, right? Or maybe all the time. So in this, you can see it looks different, right? If I go to my markup right now on NZD USD, I was looking at a few things. So let's not make it too confusing, even though I just made it very confusing by zooming in on this. But just normal areas of, let's see, where was I expecting lower price? So we actually had a little distribution in here. So again, this on its own from here looks like nothing, right? But on a 1 minute, this can look like a distribution to you, right? So if we get on the 1 minute and just look at that area up here, you'll see all those phases that we spoke about a second ago, right? You have that buying climax, right? Everything just kind of ends buying here, right? So you have that, if you just want to label it, you can. Here's your buying climax, right? Here's your preliminary supply right here, right before price made that last push before coming down to easily react off that automatic rally, right? Here's your move up to make that ST, right? So either one of these could have been ST, but let's just use this one for the sake of showing you that we've created what? You see this? We have liquidity here, right? As we start creating these highs, people are looking for what? Potentially sells. They're looking to top out this market. But as we begin to push higher, right, people start seeing these trend lines. So you already see how the trend lines get liquidated and stuff. But you get this push higher, right? That push higher is what for you? Well, notice before that push higher, look what happens, right? We create that liquidity, we get that push higher, right? Here's your up thrust. You want to call it that, right? Here you go. Here's your up thrust as part of that schematic, right? Now, what do we have? What do we have now? We form two highs that look somewhat similar. You could have thought this was the UTAD, right? And then price gets back up and forms another UTAD or an equal high. But technically, this high took out the small liquidity. So this is a 1 minute. But again, this is showing you that this works and can give you setups, right? So that UTAD does what? It just creates an order block. In reality, the simplest explanation of this is an order block creation, right? With the same things that we've learned before. Price starts to break down, showing you that it wants to go lower, right? Price comes back up, and now what can you do with this area? You can be a seller, right? So if you sold at this order block, then there you go. Maybe you had it like that, right? Never hit stop loss. Maybe you were looking to target lows down here or even lower in the form of this inefficiency, right? We never got there, but guess what? As price began breaking, right? Remember what we spoke about in terms of structure, you should have mitigated to at least this low right here. So again, that was only a 1 to 1.3, or you took out profits here, right? As the low started breaking here on a 1 minute, or you maybe got lucky somehow and took out this 1 to 6, right? But the important thing is price moved 1 to 6. And again, we're not looking at pips right now. We're looking at RR, because what we're understanding, or what we're looking at this from a perspective of, is that you have grown an account to the point where you can trade even the smallest movements, right? Now, this occurs on all time frames. The point is, this is what the market is undergoing at this time, right? And what you'll notice is, what's interesting is what I actually thought was that this area right here was my UTAD, right? So I thought that this was the final liquidation of all this stuff, right? So I was looking at this area right here. Notice if we had a sell here, right? Didn't get hit. Here you go. This is something I was looking at like this. Okay. And I was actually looking to target the lows right here. Just like right here. Right. So I was looking at that original 1 to 33. Now, price came up here, didn't enter me. Okay. Unfortunate. But I still have that prerogative to go lower. Why? Because it's showing, right? Price is showing that it wants to go lower. So what happens, right? Price keeps playing around this area. And then I think we do get another wick in there, right? So price breaks even lower, right? And here you go. You actually get a perfect entry if you got in on this. Now, because you understand this is a 1 minute, right? You're only risking 1 pip. Of course, this is not something you'd actually do, but again, with FTMO or something like that, you could be able to do this, right? You could be targeting the lows in here or just the lows, right? That already is a 1 to 20 if it finishes up, right? So maybe it doesn't here, does it? It actually comes up one more time before breaking down, right? So you see that? So again, we come down, make those equal lows, come up and break down through it. Now, if you notice at these areas, what do we have? Well, we most likely have some Wyckoffian accumulation, right? That then takes you higher after getting liquidated one more time. So this would have been like potentially a spring, right? And then you maybe get higher prices. But again, the point is markets will undergo these areas of accumulation and distribution because all it is the footprints of the composite man, like we've spoken about before. We want to find footprints on higher timeframes, and we want to find footprints on lower levels, on lower timeframes. The footprints are always going to be there because one, price is algorithmic too. So it's moving and it knows the areas that it wants to take, right? The equal highs get taken, the equal highs get taken, that move away happens. Here's your amazing entry, right? And you could have taken this all the way down to technically 1 to 23, right? And again, on 1 pip, yeah, sure, it's 1 pip, so you might have not been risking, or you weren't able to risk a lot on it, but with a prop firm account or a much higher account, you can be risking an easy $100 on this and making 2,300, right? Maybe with a little bit of spread, maybe you make like 1,600. I don't know. But the point is, you want to understand how the market accumulates and depreciates. Sorry, not that, accumulates and distributes. And this will happen on all time frames, right? So we can go anywhere and we'll start to see this occur, right? So this is more complex. This is stuff that we get into on our mentorship to understand how price moves like that. But again, it will undergo these areas of reaccumulations and it will undergo those areas of distributions, right, before coming even higher. And it will also undergo, so if we go back to the GU examples I was looking at earlier, it will also undergo the areas of accumulations, just normally, right? With that PS, that selling climax, you have the automatic rally, that ST and B, the spring, which doesn't actually go lower than the ST and B. So this is another form of schematic that you would start to learn about if you were with me, and just understanding how price moves in general, right? That spring occurs, price moves higher. You don't get a test of it, sadly, as you can see. So the test actually happened here, right? But then it started to reaccumulate. And as we moved higher, creating what? On higher and lower timeframes, order blocks that took out lows, as you can see. This is just back-to-back normal setups. If you want to think about it from a standpoint of institutional trading, here's your equal lows, right? We don't even need to look at Wyckoff here. Here's your move through the lows. Here's your move higher, right? The creation of liquidity, right? You see that? So we've created some liquidity right in or around these areas right here, right? Here's your move back down. That gives you that test right there as a perfect entry. And then you can be targeting those highs, which actually happens within the first hour. So it actually just jumps up and gives you that 1 to 4, 1 to 3 perfectly. Or if you saw something lower, right? So if we use that same area right here. So this is how you can sometimes get refined entries. So we'll just circle that right there. And we will go back and replay price from here, right? And we can go to a 15-minute. Just look at that move down, right? What we'll notice is we had that last bit of imbalance here. So maybe we look to trade off that order block. Or if we get even lower, maybe we see a little something else that we haven't seen yet, right? So I don't really see anything. Maybe this area right here, right? So this is that last. So if you want to think about it this way, I don't know if this will work exactly, but here's your equal lows, right? Here's your move through those lows, right? Here's that imbalance in there. So we can trade that order block instead of the entire order block, right? Because there's order blocks within order blocks. And we've spoken about this before, and we understand that that can work. So this could be your buy position right here, right? Looking for a stop loss just below those lows. Also, we might realize these are equal lows here. So maybe you don't want to trade that low and you want to go lower like that. But again, that entry is already at about half this order block. But either way, let's just try this and see what happens. And we're going to look to target those highs, right? So that's already a nice 1 to 9.3. And again, if this loses, you're going to get future trades that look exactly like this. And guess what? That 1 to 9 will make up for that loss within seconds. I mean, within like one trade. You can literally lose 9 trades in a row and be 8 trades in a row and be profitable doing this, right? But again, that's not what's going to happen. But the point is, you have to understand that that's what you can expect. So now we're looking at that area, right? And again, from a Wyckoffian standpoint, we accumulated here. And now we're looking for that test, right? So we had that spring. Now we're looking for maybe a test to go higher. Or from a normal institutional perspective, we have that move through the lows, and now we're going to look for that test. So again, you don't need Wyckoff. Wyckoff can help you, though, refine and sometimes spot some nicer areas or understanding of the market. You can't trade alone. So let's see what we get. We do get that move down. And yeah, as you can see, price held relatively perfectly, took off, and gave you that 1 to 9 literally instantly after entering that area, giving you that simple 1 to 9. And then again, you can take off 50% and then trail it, right? So now you've taken off, let's say you've taken off, let's just say you've taken off 50%, and maybe you noticed that, you had all these lows in here, right? And this move down took those out, and now this becomes a propulsion, right? Or as we like to call it, a second block, right? Second order block. It's an ICT propulsion block, just an order block formed after an order block. So it's just the one that hits it, right? So you could literally start to trade this up if you'd like to from what? Like maybe this last area right here. So this is that last part of that order block. Maybe you look for a buy right there, right? Stop loss below these lows, right? Looking for those higher prices. And then you can let that kind of trail, see what happens, right? So we don't get that entry, sadly. Actually, we do get that entry, right? Looking to target these highs right here for a first take profit potentially. So price is moving around here. And again, just looking at this, you can now start to see that within here, we most likely had what? A reaccumulation. So that's stuff that you're going to have to focus on your own or in my mentorship, because that's what we cover on the private. But there's reaccumulation happening here, right? You had that move through the low in the form of this spring right here. So this move down was that order block, if you want to think about it that way. And these moves in here are filling that order block in, right? As you can see. So what we're doing is right now, we're most likely going to come and take out these lows right here, right? And then maybe we can look for an entry down here. So what we could do is we could go like very low and take a look inside of here, what we see. Again, that last area we see where there's an imbalance is, I guess, right here on a 3-minute. If you really wanted to be like, if you really wanted to be crazy about it, that's where you could look for an entry if it got down there, right? So these are all just opportunities that I'm showing you where you could have looked to be involved in this market, right? Expecting those higher prices. We have those equal highs up here, so we can expect this to most likely get traded from, right? Stop loss right below that order block, no problem. Take profit here, right? That's already a 1 to 2, and then maybe even higher. But let's take a look at what happens, right? So price does make that perfect dip into it, taking out those lows. That's retail taken out, right? There's that move up. Again, what does that form? Now it's the same thing. It's more propulsion, right? So again, you can be looking for the same thing over and over again. Here you could look for an entry, right? So maybe you get lower and look for, on a lower time frame, that Wyckoffian setup to play out before going higher, right? And looking to trade that. Or you could just be entering this off of nothing else but understanding how price moves in terms of inefficiency, right? So you could be looking for this to target the highs here now, right? If we get that, let's just take a look, right? So we don't get that. Maybe we form some highs here. Maybe you look to take those out, right? So you actually do get a nice entry there, and then it gets taken out finally, right? So maybe you get to mitigate this at break even or something, or you get taken out on that. But again, all the trades prior made you the monies, all right? So again, what's important from this is that there are constant opportunities to be involved in the market, and there are footprints of the composite man that's being involved in this market because they can't hide it, right? When there are liquidity grabs and when there are order blocks formed or there are tons of orders being pumped to the market, they can't be hidden, right? And when we move in a certain direction, creating an area where we can expect movement from, right? So if we're looking at that top-down analysis, looking at a monthly area or weekly area, daily area, 4-hour order block, any of that type of thing, expecting a 50% of the imbalance, any of that type of stuff, right? We now know what we can start to look for at those levels, right? And then again, when we take a step back, we'll start to notice that within areas like that, we have larger accumulations, right? That then push the market even higher, most likely, right? And we'll just see what happens. We can just go to the 1 hour here, so we can just see what happens. right? We just played out a little bit, but yeah, exactly. You'll have those areas of reaccumulations, and that's why sometimes stepping out a little bit is a huge thing for you when it comes to trading institutionally, right? This is why we do our markups from the top down, from the monthly. Even though we don't trade the monthly, or sometimes it might not even matter for us, the reason we do it is because it puts a completely different directional bias in your mind, right? And sometimes you can really trap yourself looking at the 1 minute or the 5 minute only, right? Sometimes you just have to realize what you're looking for on a higher and then get lower and see that, right? So that's basically Wyckoff in a nutshell. We will do a lot more on Wyckoff later, right? Markets will undergo areas of accumulation distribution all the time, and that's how you can kind of look to spot them and how you can look to enter them, right? Wyckoff is nothing more. It's nothing crazy. It's not some secret sauce that you're now going to become a professional trader by if you didn't understand smart money in the first place. Because Wyckoff, an understanding of Wyckoff and how to trade it, will only come after you have an understanding of normal price action in the market. And as a good friend of mine, a good YouTuber, Pips of Persia, said, he has a lot of great content on Wyckoff. I heard an amazing quote by him, and it was that once you learn market structure and what the market wants to do, you can trade every move in the market, because every move has that essence of inefficiency to inefficiency, that order block, that fair value, that equal highs, all that stuff that you have now learned, right? You can now start to apply. So thank you for watching, guys. I hope this made a lot of sense. This is how you understand Wyckoff, right? Start to go use those on your charts, and I wish you guys a profitable day, profitable week, and profitable life. Thanks.